Hello, this is Mitchell Joseph. Welcome to Trading the Markets, free class edition. So I want to start off, going over what an option actually is for, beginners who end up hopping on this call. Um, but basically, right here. So, Trey, he's not even there. Hold on. Yeah, hello, Trey.
Yeah, my bad. I pressed the
All right.
wrong button.
No
We good.
doubt, no doubt. Yeah, because this is the beginning part. I want to, especially for you. You know what I mean?
Yeah,
Um, yeah. So, option, right? So you learned about stocks. Remember last time we learned about shares? It's just like
yeah,
a piece of ownership of a company. Well, option is basically a stock on layaway. Like you're old enough to know about layaway, right?
yeah,
Yeah, so remember layaway, you see the jacket, it's like $150, but you only got $50 on you, but you still want to buy it at 150. You don't want to come back and it's 250, right? So you go to the counter, you buy this ticket that basically gives you the right to buy this jacket at 150 up until a certain date, right?
yeah,
So the same way with stocks. You can lock in a price that you want to buy a stock at in the future, and they're going to give you a contract, basically like a coupon that locks in that price up until that certain date. Does that make sense?
yeah,
All right. So now this coupon that locks in the price that you're trying to lock in, it one coupon, I'll just call it contract because that's what it is, contract. One contract it gives you the right to buy or sell 100 shares of that stock. You following me?
hmm
So that's why this is like stocks on steroids because one coupon kind of has the leveraging power of 100 shares, kind of, sort of, depending on what happens, right? But you basically have the right to buy or sell 100 shares. All right, so that's the main thing is that you're locking in the right to buy or sell 100 shares of a particular stock. Now, they're called derivatives because they derive their price from the underlying. So have you ever heard people talk about fancy stocks talk? You might hear them say the word derivative. It's just a fancy word of something that gets the price from something else. That makes sense?
yeah,
All right, cool. So like I was saying, option contracts, they're not shares. It's a contract. So like I said, the contract either locks in the buying price or locks in the selling price. If it locks in the buying price, it's called a call. If it locks in the selling price, it's called a put. So now, and then you have what's called an expiration date, right? But I want okay, all right, before I say that, let me say this. All right. So remember the coupon, right? So just like that layaway coupon that gives you the right to buy that jacket at 150, let's say a week goes by, right? And that same jacket that was 150 is now 250. And mind you, you paid a premium. You paid $50 for this coupon, right? So you know what happens to that coupon? What you paid 50 for, now it's worth 100. So you could either give them the coupon, lock in that 150 even though it's going for 250, or you could just sell that coupon back to the market and make $50. Does that make sense?
oh, yeah. I got you.
Yeah, so that's exactly how this thing works. So I say it's kind of like sex and condoms. Like the purpose of sex is to procreate. The same way the purpose of an option contract is to buy shares. But you don't have to buy the shares. You don't have to create the baby. You can just take the pleasure out of it and get the benefit. Does that make sense?
Yeah,
Yeah, sorry. I mean that I feel like it was a very good analogy. I don't know if that went over
bro, that made a lot of sense. So don't even worry about
But yeah, so now back to what I was saying with the buying so you lock in the buying price, it's called a call. Calls make money when the price of the stock goes up because you lock in the buying price. So let's just say you got a share, right? And let's say the share is at $1. You lock in that $1 call, you lock in the buying price of $1. So even when it goes to $2, you still have the right to buy it at one. Therefore, that contract becomes valuable. It becomes what's called in the money. So whatever you paid for that when it was $1, when it goes to $2, it's gonna be at least double, maybe more, depending on like how much time is on it. You know what I mean? But that's the power of it. Same with that jacket. Once the price of the jacket went up, the price of that coupon went up. Does that make sense?
Yeah.
Yep. So by locking in the buying price, you can still buy it at a cheaper price. When the price goes up, your shit is valuable. Now, if you put, you lock in the selling price, right? So it gives you the right to sell at a certain point. So at a certain price. So therefore, you make money when stock goes down. So same scenario. Now let's just say you bought it at $2, right? You think it's gonna go down. You lock in the $2 price. You have the right to sell it at $2. Now let's say it goes down to $1. You can still sell it at two, even though the price is one. Does that make sense?
Mm-hmm.
So by you locking in these prices, when the price fluctuates and make a move in your direction by a certain date, you make money off the contracts without never buying the stock. But
I
if
have
you
a question.
want, you can. Mm-hmm.
So let's say I have a share, right? And it's at $75, right? But
Mm-hmm.
I lock it in, right?
So
And
which direction are you locking in? The buying
uh,
price or the selling price? You think it's gonna go up or go down?
no, let's say 75, right? And I
Uh-huh.
locked it in at 75. So if it goes down to 50, I can still sell it for 75 because I locked it in.
You have to pick whether you're gonna buy a call. So you have to pick direction. You
A
have to pick
put.
whether you think it's gonna go up or whether you think it's gonna go down. You can lock it in for both ways.
Okay.
So if you think it's gonna go up, you can lock it in at 75 so that you can buy that 75 when it's higher. Or if you think it's gonna go down, you can buy it to lock in 75 so you can sell it at 75 when it goes down.
Okay, I got you.
Yeah. All right, bet. So now, along with that, options they have what's called premiums. So the price that you buy the option at is called a premium. All right. Now, like I was saying before, one option contract locks in the price for 100 shares of stock. So when you see the prices listed as premiums, you're gonna see like dollars and cents. But understand, you have to multiply it by 100 to get the dollar amount. So what do I mean by that? So you will see an option contract listed as 2 cents. You know what I mean? But that's really $2. You'll see a price listed as $1.50, but that's really $150 because you have to multiply it by 100. So if you see $15.55, that's basically $1,555. Does that make sense?
Yeah.
All right, so let me show you some examples so you can, so it can make sense. Let me go to Robinhood real quick so you can actually see like examples. You know what I mean?
Mm-hmm.
So let's say Ford, right? Easy one, Ford, right? Ford Motors. So pre-limit orders. All right. So right here on Robinhood, you go to trade options. This option will not show unless you enable options trading on your platform. When you start off on Robinhood, they don't want to give you this because you can you can lose a lot of money if you don't know what you're doing. So now this right here is called an option chain. Notice first thing right here, they have the expiration dates. These are different days you can buy out, to trade whatever you're trying to lock in, right? So now, like notice, right? The price of Ford is right now is $11.89. You see that?
Mm-hmm.
So now, right here, up here, I could either you can also sell them, but we're only going to focus on buying them. Just know that every trade is a two-sided, it's a two-person trade. So whenever I'm buying it, it's somebody that's selling it to me. But just to keep it simple, right? You could buy the call or you could buy the put, right? So do you remember the difference?
Yeah, put is when you sell, call is when you buy.
Yep. Call makes money when it goes up, puts makes money when they go down. Yep. So now let's just say call. Let's just say we think Ford is gonna go up, right? So notice right here, let me annotate so you can notice a couple things. Strike price, break even, and the actual price. We'll just focus on those three, right? So you'll see like this. So this right here, the strike price, that's the name of the option. That's the price that you're locking in. So when I say I'm buying a call, I can say I'm buying a $12 call or an $11 call. That's the lingo. Does that make sense? I'm basically saying what price I'm locking in, right? So now let's just say I buy this $12 call. Notice that it says how much is it? This is the price. This is the premium. How much do you see that right there?
12 cents because times 10 would be $12.
Well, times 100.
Times
But yeah.
would be
So yeah, so
dollars.
you see, yeah, so you see 12 cents. But if I was to buy this right now, I would need 12 bucks. All right. Now, now I'm gonna go in a little bit. You know what I mean? Stay with me. Let me know if you need me to slow down, but this is probably like real important for you to understand. So remember, this is a chain, right? So this middle line right here is called at the money, right? Now, since we're talking about calls, right, and they make money if things go up, notice that to lock in the lower prices costs more money. Does that make sense to you?
Mm-hmm.
So everything in here is called in the money. Why? Because if I buy the $11 call, I could, go ahead buy 100 shares at $11, even though it's at 11.89. You know what I mean? So therefore, it already has money attached to it. You already make a profit just from buying. So that's why it's called in the money. And then furthermore, the break even price is a much lower. You see, it's only a couple cents away to break even if you were to buy this. You understand? And mind you, this is the weekly expiring this Friday. So you only got 4 days expiration. But the main point is with the calls, at the money is basically at the price of the stock, right? So since you see it's 12.89, this $12 is the closest price that's closest to 11.89. So that would be considered at the money, but it's also considered out the money. Does that make sense?
Mm-hmm.
It's out the money because price needs to move for these to gain value, for them to become in the money. And notice the break even. So if I bought the 12.50 call, the price would need to move to 12.50 for me to break even by Friday. Versus if I buy in the money, it only needs to move to 11.96. Does that make sense?
Mm-hmm.
Because that's in the money versus out the money. All right, boom. Not gonna spend too much time on this, but it's basically very crucial for you to understand if you want to trade options. Definitely take some time to understand this. And real quick, it's the opposite for puts.
Can I ask you a quick question though?
Yeah,
I have to call real quick.
yeah.
Why is that one on the bottom green?
Probably just because it might have changed. Its price changes, like and maybe it went up at the end of the day versus the other ones went down by the end of the day.
Got you.
Yeah, compared to the price that it started at, that's all that is. It's not nothing special. But yeah, so that's the basis for you to understand, when it comes down to it. There's other stuff, but I don't want to dive too deep into the intricate parts of it. I'll just kind of show you like what happens when you trade them. So now, yes. So how do you make money, right? So what you want your stock to move, to make an expected move, to move as much as you expected in your direction by the expiration date. So basically, just like that layaway ticket, we want to buy that ticket for 50, have the price goes up on the jacket, sell it back to the market for 100. That's what we want. And that will happen if it goes up, versus imagine they made like a reverse ticket, right? And it's like if the price goes down, then it would have made money on the way up. So let me show you some examples. All right. So I know there's a lot going on here. Actually, I think Robinhood is better. Yeah, Robinhood is better. So, do I have an example? Oh yeah, I do actually. Hold on. Let me go to my journal real quick for y'all so you guys see some examples and stuff. Let's see this one. All right. All right. Here we go. Let me share the screen. So this is my trading journal. Like I basically been using Microsoft OneNote to organize the weeks, the trades that I take. So here's a trade that I took, right? But notice, so come down here. So right here, you see this right here? So
Yeah.
this is the Wells WFC. This is Wells Fargo, right? 46 call. So I'm locking in the $46 price on Wells Fargo, right? Now I bought, so right here, let me annotate. I bought two contracts. This red. Right. So you see, I bought two contracts at an average price of how much did I pay for the contracts? Can you tell?
It was 14 cents,
Which means I really paid
$14.
exactly. So I bought two of them. So I spent 28 bucks, right?
Hmm.
Now these contracts they went from 14 to 20. So my 28 bucks made 12 extra bucks. So basically that's at 40. Yeah. So basically I turned 28 bucks to 40 bucks from this trade where I made 42%. Does that
That's
make
what's up.
sense? Yeah.
Yeah.
And mind you, like it's not a I think this is a day trade, you know what I mean? Like, let me see. Wells Fargo. Uh, which one? So yeah. So yeah, they were day trades, you know, like right here, yeah. So this was a day trade. You see, I got in at 8:59. You see that? I got out at 9:28. So that's a good what? 24 minutes, right?
Mhm.
You see I bought 12:14, sold one at 20, sold one at 19. So basically I made 40% off that. You know what I mean? And then I did another one on Webull. I got a 901, basically the same trade. Got out 925, 1420, basically the same trade. And like right here on Webull, it's the same trade. You can see right here. You know what I mean? So this is a different platform called Webull, not Robinhood. But if you understand what to look for, everything is still there. You know? So you see the average price. Let me annotate. Average price. Um, right here, average price 14, mid price 20. See, the cost was 28. You know what I mean? See, market value was 38. You see what I mean? So
I
this is
want to ask
basically,
you a question
yeah.
before you move on. Not to interrupt you.
No
So,
problem.
why would you switch platforms? What would be like the Is it like a strategy to that? Actually going from Robinhood to Webull.
So what I like to do, right? I have multiple platforms. So
Mm-hmm.
I like to test the waters on one because let's just say I bought this, right? And it didn't go in my direction. And what I bought for 14 went down to 10 or went down to 9, right? So now I can review the play. Is the play still valid? And if it is still valid, I can get in at a cheaper price on a different platform. Does that make sense?
Okay. Yeah.
Or
Yeah. Yeah. Yeah.
or let's just say you want to just make double the money, just do it on two platforms. You know what I mean? So I made
Oh,
14.
So,
14.
contract.
in,
Yeah.
in that sense, like, wouldn't you just like buy? I mean, because essentially you still just buying another contract,
Yeah, yeah.
right?
I'm just buying it somewhere else. Yeah. That's it.
Okay.
Yeah.
Okay.
Yeah. So I use Robinhood, I use Webull, and I use Thinkorswim, which is like the one that well actually I didn't show you guys, but Thinkorswim is it's more scary looking, but it's
Oh
more
yeah.
it's more straight business, you know. Robinhood, they make it look pretty, trying to make it look sexy just to just take your
Mm,
money. You know?
right.
Yeah, so that was, you know, what I mean, so yeah, so this was like the day, you know, like on this day, it was a good day, you know. But that these are some examples, but also look at what happened, you know what I mean? So you could see on these charts, you know, where I got in and where I got out. So I got in down here, I got out up there. So if you look at it and you could see it right here, stock price 44.64, got out at 44.95. So that's a what? 30 cents. 30 cents made me that 40%. Maybe I made 40% off a 30-cent move in Wells Fargo. How nice is that? You know what I mean? You guys follow me?
Yeah.
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 So at the end of the day, what was beautiful about the reason why these are stocks on steroids is because they're highly leveraged. So if the same movement a stock does, this moves a lot more. You know what I mean?
Exactly. The
Yeah.
option.
Yeah. So yeah, I guess I could show you guys a couple more, right? What other trades? So here's some other trades. Let's see if I have screenshots of the option contracts. Because I don't put them on every one. Not just charts. I know I have more though. There we go. All right, so this is Thinker Swim, right? So check this out, right? So this is SPY, right? So as you can see, this is SPY. I got in right here. I got out right there. And I got out right before things dropped, right? Um, and you can see, you know, the price it was 455 and then 452. I think that's wrong. But 11 and 17. Yeah. So right here, you can see, let me erase it. Clear. All right. So this is the same thing, just different layout. Trade price, how much I paid for it. This where it went. How many contracts? I had one contract. I spent $11 and I sold it for 17. So I made $6. All right. And mind you, this is understand this is one contract. So I paid $11. So if I had bought 10 contracts, it would have cost me $110. And then instead of making $6, I'd make $60. Does that make sense?
Yeah.
That's following me? So in the same token, if I bought 100 contracts, it would have cost me $1,100 and I would have made $600. That's
So
how it works. Hmm?
I have a,
Go ahead.
so so do you take risk, like, or do you just know, like, do you see like a trend of when it's gonna go up, or?
Yeah. So like going up here, it's called learning how to read the charts and all that. It's called technical analysis, and that's what I'm pretty proficient at. So right here, right? So notice, right? How did I enter this trade? So this is the 1 minute chart. Draw. I'll take. Yeah, so right here you see it says 1 minute. So this is a 1 minute chart. So every candle represents 1 minute. So I use this strategy called orb, ORB, which stands for opening range break. Opening, I was right, open range break, right? So now what you do is very simple. As soon as the market opens, you take the very first 1 minute candle right here, you mark the high, you mark the low, right? Now, what also helps me is that if you go on the chart, it was on an uptrend. So I knew to look for calls. So like if I was to go out into like the regular chart, I'll show you in a bit after this that we were actually going up, right? So once I know that we're on an uptrend, I know that as soon as we break this right here and the candle closes, so understand the whole time the 1 minute is going up, the candle's going up, is going down, is going up and going down. By the time that 1 minute is finished, then this candle appears. You know what I mean? So every minute a new candle closes. You know, so once the candle closes above that orb, I get in. I get in. This is a quick strategy to get in. And why do I get in? Because it's only been one candle in the day. So if I am wrong, I'm gonna put my stop loss right here. I'm only gonna risk one candle. Does that make sense?
Yeah, that's the lowest. You see, the lowest is it opened at. So you basing your projections on basically the
Either
opening
it's gonna go
and
higher or it's
the high,
not, and
right,
I'm out.
the highest point and the lowest point of that first candlestick.
Yeah. So
Right.
I'm looking at see what price breaks the top of it or the low or the bottom of it, and then so there's another piece to it, right? I wait for a retest for confirmation, right? So a retest is basically this, all right? When what you really want to get into stocks and plays is you want it to break the level and then come back to that level and then shoot up from that level. You want to get in right when it starts shooting up and it confirms that. Does that make sense? So to me, this candle closing above, it was a deeper retest of this level, But once I seen this green candle, like, well, I got in right on this candle. So maybe it would not kept pushing higher, but I took that chance. I took that chance. Because to me, this is a retest, but a retest deeper, because if you look at this level, it broke this level, came down this level, then it shot up. You know what I mean?
So you getting up when you see that it
That
didn't
it
reach the
closes.
low, but it's trending up.
One,
It's
yes,
trending up
yeah,
from
because
what.
yeah, it's trending up. So once it
Right.
closes up and the candle is done, closing above that level, then all I need is another candle to confirm that, and I'm in there.
Right.
Yeah. So does that answer your question, Trey?
Yeah.
Yeah. So that's strategy I use a lot, and I'll show you more examples. Um, and then we could talk about like what's going on in the market. I know Trev's got some stuff to bring up. Let me erase this. Let's see if I'll find you guys one more example, right? Yeah, this one right here was one. Was it this one? Hold on. This was a good trade too. Did I use the orb on? Yeah, yeah, this one was the orb. Okay. So I just had it it's on the 5 minute, 30 minute. But I think this one was a 5 minute orb. Yeah, so all right, so same strat, but okay, so you see, let's see. So this was the orb. This was the high of the first candle of the day. Notice it's 8:30. This is when the market opens where I'm at because I live in Houston. So it opens at 8:30. So this is the first 5 minute candle. This whole thing is a 5 minute candle. But this purple line was from the 1 minute. You know what I mean? So once it broke this right here, the 1 minute candle, I could have entered right there. But let's just say I missed that. Once I seen that we came up again here and rejected, that's the entry to go in because I'm still playing off that range and I'm seeing how the trend is reacting. Because what do I want? I always want a break, a retest, and then shoot down. You know what I mean? So that's basically what I was waiting for right there. And it ended up playing out. Like, look right here. Look how it shot up right into the zone and then it rejected. So I basically there's different strategies. Like this one I had a whole box because I knew that this was called a supply zone, which is basically a zone where sellers like to sell. Because you see there was a big sell-off earlier from this. You see how like it sold off earlier? It was a big sell-off from this zone. So I knew that when it came back into this zone, there's a high probability that's gonna get rejected. And then I put that combined with this right here that I use as an indicator that shows me resistance. So remember, every price has a floor and a ceiling. Once you identify where the floor and ceilings are, you can wait for it to bounce off the floor or bounce off the ceiling to play the continuation of that direction. Make sense? All right, cool. So that's that. Now let me get into like the market where we are now, what's going on, plays that I'm focused on. All right, so now let's go to the regular charts. Let's see. All right. So this is a trade I took today. I actually took two trades on this today, and one of them is still open. But all right. So rig. So trade, like I trade this like a lot. I don't just own the stock, I also trade it in both directions, depending on the day. So this one, all right. Let me get to like the 15 minute. All right, so this is my first entry, right? And then why did I enter? I use indicators. So I know like whenever I use these clouds, notice that when the clouds get skinny, it becomes red, and then it gets fat, then it gets skinny again, then it gets fat, then it gets skinny again, and if it starts moving the other direction, it becomes green. You guys kind of see that? So basically, these clouds, they're like floors and ceilings to me, right? So once I seen that, like, okay, even on a small time frame, I think when I was on the 5, I seen that this cloud was starting to shrink. You know what I mean? It's starting to shrink. On top of that, you see all these wicks, these are weaknesses. So they're showing a lot of rejection. This is where price was, but it's no longer there. These are the highs. So I'm not sure if you know how to read these candles, but basically the body, if it's green, the blue is green, it goes up. The bottom of the body is the open, the top of the body is the close, and the wicks are the highs and the lows. So I seen a lot of rejection and I seen the cloud flip. So that I entered right here. And then what was my target? My target was this right here, the fill of this gap right here. So once it came and filled this gap, I was out. You know what I mean? And then it started bounce up a little bit. Then it kept shooting down. So notice I got in right here. I got out right there. Made about 20%, right? So, and then you see the 5-minute candle. So 5, 10, 15, 20, 25, 30, 35, 40, 45 minutes, right? So then I got in again down here and I'm still in this trade. And you see it's been going nowhere. But the first trade was a success. So now I just manage my position. I do see it going lower still. But it all depends on what happens with oil and everything like that. You still there, Trubs?
Mm-hmm.
Yeah, so yeah, we'll see what happens with oil there. But as far as oil, let me look at crude oil because crude oil is the futures. They control where oil wants to go. Right now, oil's been bouncing, so maybe oil might go up. You know, just from me looking at it. And like all these clouds are like they're all just ceilings and floors. So red is supposed to be the ceiling, but no, it's breaking through the ceiling. And then there's another ceiling up here that it may break or reject like it did right here. You know what I mean? So
Mm-hmm.
I'm gonna really wait and see. The point is don't guess, wait for certain things to happen first, and then you make your move. So I might be like, for example, like let's say if I made a plan, I might be like, okay, I like this downtrend. I think it's gonna keep going lower, but I need to get in somewhere safe. So I might be like, okay, we get back in here in this box, I'm buying puts and I'm riding it down. But I'm not gonna get in until it gets back to that box. Does that make sense? So like maybe it may never reach it, but at least that gives me a plan of action on what to take, you know. But so one thing I'm doing right. So here's a play I'm doing right. I think I could show you guys this in the last 2 minutes, right? So a play that I'm doing tomorrow is well, I'm looking to play tomorrow's fuel cell. So as you can see, I already have my play already set up. Where I want to get in is down here. I wanted to come down more so I can get in. It look like it's been falling. It look like it falls some more, right? But what's important is this right here. You see it says earnings. So what's special about stocks is that they have earnings every quarter. So earnings is when things move up and down like crazy. So this is an opportunity to make a lot of money if you just play this day correctly. So a lot of people guess on like which direction is going to go. I'm not going to guess. I'm going to wait to see what direction it goes after they give the announcement. And then what I'm going to do is implied volatility in the contracts. I'm going to wait for them to go down, and then grab these contracts and hopefully it does something like this. And then here's the contracts. Let me go to Robinhood again. Uh, so here's the contracts that I'm trying to play on my watch list. Fuel cell right here. Yeah. So these are the contracts that I'm trying to play. So notice this is fuel cell. It's the one oh no, this is the put. Let me actually I looked at both of them, but I actually want to play the call. Let me just show you guys this real quick and then this time's about to run out. Fuel cell 1.5 call right here. Yeah. So these are the contracts I want to put today. So I added them yesterday. They were 15. Now they went to 20 today. And then you see like they started up at 36. They finished the day at 21. So it was a lot of movements. And basically I'm looking for this number right here. That's his implied volatility. I didn't teach you guys. But when this number goes down, it's gonna lower the price of these contracts for me to get a discount and swoop in from behind it after everybody's been hurt or clapped in the market. But yeah, so that's my play, guys. Definitely thanks for tapping in. And have a good night, y'all.
All right, yo. Thanks for everything, Rich.
No doubt, no doubt. Peace out.
All right, peace.
All right, and I'll drop this recording on YouTube, by the way. I'm gonna drop this on YouTube.